as mentioned, we're going to talk about the digital transformation and the risk in financial services. And this discussion is going to be moderated by Mr. Edmund Green. Edmund is a managing director in KPMG LLP's risk consulting practice with nearly 30 years of cross-functional experience, including commercial and consumer credit, treasury operations, risk management, and internal controls, primarily with Fortune 500 financial service companies. Come on up.
Good afternoon. Oh, come on.
Let's get a little life in the room.
Yeah, good afternoon. There we go.
I'm going to kick this off.
Yeah.
I'm from New York City. I grew up in the Bronx. I'm a Yankees fan, and my father's best friend was Wellington Mara, so I'm a Giants fan. So that's for all you folks from Dallas.
And we won't hold that against you, Bill.
He's a likable guy anyway.
Nobody will believe a thing I say from here on in.
Awesome. So thank you all for attending and for your attention this afternoon. The last group of presenters really kind of teed things up nicely for us here. And what we wanted to talk about, and really just in more of a conversation between Dan and Bill, is risk management, and more specifically, how digital transformation and the automation of processes has changed the nature of risk management. And so, we thought that would be a very interesting topic to cover. And what we mean by risk management is the process by which an organization identifies and responds to threats to its existence, strategy, and business model. And so it's, some of the things that the last team talked about, but some other things as well. And so with that, I'm going to start by having Bill and Dan introduce themselves, and then we'll get right into some of the questions that we wanted to cover with you all. Is that okay? Okay, so Bill, why don't you go
Hi,
first?
my name is Bill Sweeney. Recently, I was the Chief Risk Officer for the Clearinghouse. For those who don't know the Clearinghouse, it has a spin-off that we all know today as the Federal Reserve System. It was the Federal Reserve before there was a Federal Reserve. Before that, I was with Citigroup and HSBC as the Chief Technology Officer for the investment banking side, the risk management side, and I also spent 4 years at Bridgewater Associates, which is the world's largest hedge fund. So mostly about risk is going to be about financial risk. And I do want to make this relevant. So how many people here are from the real estate business as opposed to any others? Primarily real estate. All right. And the reason I say that is we want to make this more relevant to you. So if you have any questions about that, we'll come back to it.
Okay, Dan?
Thank you. Hi, I'm Dan Smith. I'm with a company called ComplianceEase. I've been there for 14 years. We are an automated compliance service provider, primarily working with financial institutions. Glad to be here with VRM as well. They're a great partner of ours. Prior to that, I worked for Fiserv, helping folks do valuations of their servicing portfolio. Our company's headquartered in San Francisco, but I'm based in Fayetteville, Arkansas, so not too far from here, or as the folks in my town call it, UT Fayetteville, because there's so many folks from Dallas that make their way up. One little tidbit about me before we'll turn it back over to the discussion here, and that is I am actually ironically also in discussions with Aaron Sorkin for a movie about my life. We're unsure on the title, but we think it's probably going to be something like Dan Smith, family man by day, regulatory mortgage compliance analyst by night. Weirdly, the production budget is going to be really high because there's tons of explosions.
I'm volunteering to be the guy who beats them up.
So,
Excellent.
Yankees fan, typical.
That's it. So thank you, gentlemen. So why don't we just get started? Bill, you talked a little bit about your background. What I'd like to do is maybe just kick off with you describing from your vantage point of years of experience in financial services, a technology-dependent, technology-centric, technology-enabled business. How has the nature of risk management changed as a result of processes becoming more automated and digitized from your point of view?
The best way I could think about it is to go back to, when I got my first house, right, and I had to buy a mortgage, get a mortgage, right, and I went down and I went to the banker and I shook his hand and I looked him in the eye and I presented some financial numbers, and he looked at me and he kind of, based on an eye-to-eye contact, granted me a mortgage. Now that human touch has been taken away a lot, right? I mean, we automate the processes. We not only have digitized it, but now we have a whole bunch of risk management tools that we run on top of it that are automated. We're using a lot more of machine learning decisions, a lot of things where we look at you as how do you compare to others in order to get a better sense of what the risk is. The problem is you tend to lose that. How do I understand what happened, right? You know, how did I get approved and somebody else didn't get approved? And it really goes to the whole way that machine learning works. And I don't want to get too technical for this group, but there's really two sides where risk manages to real estate, right? There's the extension of risk, the extension of credit for your people who want to buy, right? And then there's the banking side, which I'm more familiar with, is just how do we make all that money available? We're taking all of those loans and we're securitizing them and selling them off so that we can then have more cash. And risk really controls both sides of that, and it's becoming far, far more automated, where there's no more human discretion, or much less human discretion, right? It's the impact on the banking side is going to be a reduction in the number of people involved. It's going to be there used to be having your senior managers managing your junior managers, managing your entry-level people. The entry-level people are gone, right? Because they were just doing tasks, and now the machines do the tasks. It's all digitized. People put their information in on the web. That they don't talk to anybody. They get an approval over the web, right? And there's that loss of understanding of why somebody got approved or disapproved, right? And figuring that out is very, very tough.
Gotcha. So Dan, based on Bill's response, from your perspective in the realm of compliance, what are you seeing in terms of how the very nature of risk management itself has changed and will continue to change in a more digitally transformed environment?
Right, good question. And kind of segue off what Bill said about a loss of kind of an understanding on that process. I think that is why one of the answers to in the last panel, there was the Q&A about reasons why new tech is slow to adopt. And one of those reasons is that one of the answers, I think it was the third most chosen answer, was concerns on a regulatory or compliance standpoint. And that's it. Compliance is going to adopt, and it's just going to be, in many cases, the last thing to adopt. And in some cases, there are some good reasons for that, but it must adopt. It must adopt as well with the new technology, because you can do so much more with it. An example from a regulatory standpoint or governance standpoint is that there's opportunities to adopt internally within your organization, and you must, but there are also changes that are occurring on the external side or with the federal and state regulators. So from my perspective, a little further downstream in the real estate process and the mortgage world, there's the concerns about was the origination compliant? And you have there means different things, but one of those, and I think it also is apropos in light of some of the discussions that occurred this morning, are what does it mean to be compliant? And it's not just looking at a loan in a vacuum. It's looking at an individual loan, and it's also looking at a portfolio and asking narrow questions such as, did this loan have the proper adherence to the regulations? Was it tested based on the appropriate state license type? Did it adhere to the TRID requirements and the federal testing and so forth? Did it fall into an anti-predatory situation? And then there's the larger question of the portfolio of loans, which is within that portfolio, was there consistency? And in the event that there wasn't consistency in terms of how things were applied, was it something that falls into a discriminatory pattern?
And one of the things, I just want to jump in here because
Yeah.
it's something you said, is it's not enough to say that something is approved or disapproved. You have to say it's done in a compliant way. And, you know, how many people here have, over their last 10 or 15 years, felt like decision-making has moved away from them? That other people now, other people or other decisions are being made that they have to live with, right? It's actually the way it's gone, right? Where you'll read about big data, you'll read about machine learning, because what we're doing is we're taking these huge data sets of all this history, and we're saying, now we'll train these very sophisticated algorithms to operate that way. And he was talking about how to be compliant. Well, you know, the fact is, if you go back far enough and you had bad lending practices, your data is going to have bad lending, right? And guess what? When we build it into the system, now your system will have bad lending. It's not something that is miraculously going to come. So the whole question about compliance and governance and how do you swear that you are doing your job well becomes harder, because like, I don't know whether or not that data has been vetted. I don't know whether it's been cleansed. And that could be, like I said, historical. It could be deliberate. It could be somebody who's hacking your data and wants you to have bad results, right? Or it could be inadvertent, right? Just turns out that the data set that I got was biased, right? And it's not enough to have somebody, well, by the way, I'm a math major, computer science guy, right? Not a real estate guy. So you give me that data and I will get you answers. But I may not really understand all the nuances and everything else, and certainly the legal aspects of this. How do I make sure the data set that I'm training my machine on is compliant with the law and regulations?
And we're going to talk about some compliance culture
Yep.
in a little bit. But one thing interesting, Bill, to jump in about what you said about the doing lending poorly. There's, just to draw a distinction, I think obviously that whatever you do, whether it's real estate or you're filling your pipeline or how you're servicing your customers and clientele, whatever business or industry you're in, you can do it poorly and still not fall into patterns of discrimination.
Right.
Or and the inverse is true, but typically there's a high correlation. But we have analyzed certain portfolios of loans, and it's interesting. We might look at a certain lender and see that they're very consistent across the country and the parameters that they've set forth, and they know what they're doing, and yet there's some patterns of discrimination that we've been able to determine in certain areas. And then there are others, you look at it, and if you look at two loans, you may have an African-American applicant who was denied and had better qualifications than a white family or whatnot. And yet that company was not falling into patterns of discrimination, because when you really dig into the data and you run regression analyses and you set up your models, it turns out that they just were really inconsistent and capricious. And that there are all sorts of examples, and that they just didn't know their business very well, which is somewhat related. But
these are very good points. And so it seems like what you're saying is that as it relates to risk management, whereas before we may have a practice of looking at outputs from systems, it sounds like the locus of control and the focus of risk management needs to move much more forward in the design phase and the analysis of the data that goes into the models, so that as they're being developed, you're actually making sure that inherent biases and so on are not included in those solutions.
One of the things about risk management, right, is it's such a broad term, right? And you actually have to sit down way up front and say, what risks do we have to manage and what are our goals? Right. We had the keynote speakers up here before, right, and they were talking about inclusion, right? And they were saying, look, we are trying to get people to consider inclusion. Well, if I take a machine learning model and I train it to say, here's how I maximize so I get the fewest number of defaults, and I ignore inclusion, I'm going to get something that doesn't actually meet the goals of the company. Right? So you have to think about all of these things holistically, and if you build for along one axis, you can end up in the wrong place.
And what both of Edmund and Bill are talking about is a little bit along the lines of not having the approach of we once had humans and everything was manual, and now we're moving over to machines or machine learning or AI or whatever, and that's going to replace everything. It's neither one nor the other. It's integrating both, and intelligently, building things in the front, auditing it, to steal a term from Edmund, it's systems learning, it's hybrid intelligence, where you really have to apply things carefully on the front end to not have data bias your output, and then have processes where you are evaluating it throughout. One suggestion that I'd heard was to have a sort of information fiduciary, where everyone knows what typically you think from the financial fiduciary standpoint, there's a responsibility. In the same way, someone is identified as responsible for the answering these questions and ensuring there's some QA around it.
That's interesting, right? Because it's not more than 10 years ago that we came up with a whole new board member role, right? The chief data officer, right? Before that, there was no concept of a chief data officer, right? And then what happened was we had these systems and the data was never consistent. It was never correct. We were spending a lot of operational cycles fixing it. And so we brought in a chief data officer to make sure that it was at least consistent and correct. Now we're talking about bringing in somebody whose job is not only to make sure it's consistent and correct, but given the way we're using data today, is actually compliant.
Absolutely.
Excellent, excellent. So let's shift the conversation more towards business performance. Because I know in my work, oftentimes, when we go out and talk to clients about risk management, the response that we get is, we don't need no stinking risk management. We're trying to make money, right? And so there's a misconception that I want you gentlemen to speak to, that somehow the implementation of rigorous, robust risk management slows you down, and indeed, is a detriment to performance. And so, Bill, do you want to talk a little bit about how digital transformation, and particularly risk management, can help organizations to achieve strong performance, achieve good customer experience, and so on?
Sure. I think let me start with how risk management was traditionally structured, right? You had a business idea, right? And you said, let me go pitch this business idea. And risk management would do a review up front, and they would say, yeah, within these limits, you can operate, right? And then risk management was at the back end. A, making sure you stayed within your limits, and B, calculating any, regulatory capital charges or anything else that went along with it. And now, with the total digitization all the way through, right, you're actually saying, we're taking all this data, these things we've learned, these machine models we've built, and we want to put that all the way at the front, right? We talked about, that everybody has their phone, right? Well, this device can be downloaded very easily with a risk management model. It can be built into your application. So, and what's actually happening up front is not just the yes and no, right? It's not the, hey, I wanted to get a car and I got turned down for the loan. It's the, I wanted to get a car and I got turned down the loan, and this is why. And this is what it's telling me to do. It's saying, look, you need to have more savings, or you need to reduce your credit card spend. Or, this is how we can help you live your life better. It's guiding people along the way. So risk management is always about, somebody said before, everybody thinks of audit as a department of no. Right? Risk management's only half a step behind that, right? Risk management only gets involved when we're telling people they can't do something. Otherwise, they're like, oh, got the green check. Yeah. So, but what we're trying to do is get it all the way where the whole concept of how to do things better so that you get a better result overall is built all the way up front and all throughout the whole process.
Gotcha. Excellent. So Dan, again, on the compliance side, any thoughts on how rigorous, strong compliance can actually be a competitive advantage, particularly for some of the larger legacy organizations and ones that might be going up against the fintechs and such?
That's a great question. I think it's equally important to think of it in those terms from a competitive advantage, that it is a competitive advantage, whether you are with a large organization, but just as important if you're with a small organization as well, and for different reasons. But one of them on the face of it is, if you think about how you go about complying with whatever requirements there's a governing body that's going to evaluate how you've done. And so in many cases, there are some clear consequences, could be for lack of compliance. And it could slow down your business. You can have your license, revoked. A big thing that I don't think gets talked about a lot, or enough, I should say, is the reputational risk that's a part of non-compliance. And so there are some kind of the stick side of it, and I think that in some cases companies have sort of picked up on that, and the notion that if we have a compliant process and we can demonstrate that we're compliant, then you kind of have you inculcate kind of a culture of efficiency and transparency that can extend beyond just adhering to some requirement. Especially in the world, I mean, you talk about the data and the data officer. That's no more true in the world of compliance. And to do compliance right, you have to do data right. And part of that can be embracing new technologies, classification of data, pulling data from documents. You start having technologies like OCR and ADR and so forth. But thinking data through in terms of your workflow. What systems do you have that you can use data to benefit from? There's one example I think of in the world of HMDA or fair lending is it's data heavy, and it's actually the CFPB has required more data that gets sent. Not only do I think that affords an opportunity to be compliant and to do that carefully, but you have a lot of information on your hands then with that data that you can utilize to expand your business in concerted, deliberate ways.
I'll just jump in with one other thought here, which is, technology, he was talking about all the regulations and that being data heavy and how hard it is to comply. And for many, many years, that was an advantage to the big company, because you had a certain amount of overhead that could be absorbed by the big company, right? I could afford to build the big data center. I could afford to buy all those computers. I could afford to buy the quant who could do linear regression analysis and stuff like that. What's actually switched now with technology is it's all out there, right? This whole concept of cloud-based services means that any small company can have access to just as sophisticated a system, right? Something that does OCR on documents and then does semantic analysis and things of that nature, so that you can actually get out there and say, well, I don't need to have armies of people looking at this anymore. I can do this in a streamlined way, get better decision making, get better insights, risk insights from using and leveraging a system. So actually, I think that the technology has now swung the pendulum back to the smaller organization, because the larger organizations still have all that overhead, and they still have all those people. And believe it or not, in many cases, those people don't want to give up their jobs just for the technology, right? They're sitting there being a little bit more resistant, because they're going, if they put that in, I'm going to be laying off 10 of my people. If I lay off 10 of my people, I fall below the number that considered a VP level, right? And it's really almost like I said, coming through the cycle again.
One thing on that, Bill, is that in addition, now that the cost of some of these technologies are coming down, and it's not a matter of can I have access to it, it's what do I do with it?
Yeah.
Just a side note, I think that just underscores the point of what was made before, that diversity of thought, cognitive diversity is that much more of a competitive advantage, because especially if you do have a smaller number of folks on it, you definitely need people from different backgrounds to look at the data in different ways, rather than that's where the power of these processes can be harnessed, is have different questions being asked about it that other people might not ask.
Yeah, it's very interesting. I know in my work, we're the regulators, for example, have recognized that business models have changed to your point, where organizations are outsourcing mission-critical processes to third parties. And now the focus of risk management is around third-party risk management. And again, as you can outsource the process, but you can't outsource responsibility for the risk. And so the process by which you conduct third-party risk management is very different from a process, of risk management around activities that you own internally. And so again, the landscape is changing and shifting, and we have to be able to adapt to those changes in terms of what we do. So It's very interesting.
And along those lines too, a lot of times doing compliance right is of course it's critical, but it's also a foundation or a jumping off point to be able to answer those larger risk management questions of a strategic nature. What are the bigger strategic areas that we need to be mindful of?
Absolutely. So let's go to more to the governance side, and again, Bill, with your years of experience, and Dan, I'm sure you guys have a lot of experience dealing with boards and such. And so, Bill, I guess the question for you is how will the nature of risk and compliance governance and oversight change as a result of the digital transformation of a lot of processes and automation and such, particularly at the board level? What are you seeing?
Okay. Well, I think what we're really talking about and we're seeing is a shift from people doing the job to computers, machine learning, algorithms doing the job. Boards still have the responsibility for setting risk appetite. Their role primarily was to make sure that the people, the processes, and the procedures to control risk were being executed well. They relied on internal and external auditors to give them a report that said, yep, my internal auditors say they're doing it, my external auditors say they're doing it. By the way, hands up all those people who've never received an audit item. Somebody's lying back there. Or just graduated yesterday. That's what their job was. Their job was to make sure our processes were all working, right? Well, now we're in that space where, hey, the board still has that responsibility, but that process is an opaque, machine-based process, right? And now, how is a board supposed to guarantee that it's correct? Well, it changes what an auditor has to do. The auditor has to come in and be able to say, I can look at this data science-y type thing and verify that it's working correctly, right? It changes what the chief data officer does, because he's got to come in and say, hey, I've looked at your data, and you're not introducing bias in that space, right? You're not, we can not only see it and the output that loans are being granted properly, you're getting the right distributions, but also in the input data, right? That you're getting the right right data. So I think, and the boards, right, are going to sit there and say, they don't know anything about data science. They don't know anything about machine learning, and they can't plead ignorance, right, when the regulators come in. Right? They're going to have to get, they're going to have to get informed about how it works. They're going to have to get informed about how you control it. They're going to start to hold their internal auditors and their external auditors responsible for being able to bring people in who can verify this stuff. I mean, in my mind, I can actually see, external auditor coming in and say, just give me your data. I'm going to rebuild all the models myself, right? Because I can do that using a web-based app, right? A cloud-based app. And I can then see, look, here's what my model says. What does your model say something different? Why is that? What did you exclude? What did you include? It's going to be a much more invasive, data-oriented type of audit. Because, quite honestly, the algorithms have become standards. Right? They're, whether you want to talk about random forests, or you want to talk about k-nearest neighbors, or you want to talk about ensembles, it doesn't matter. They're available on these cloud-based services. And they're available to the auditors, they're available to the regulators, and they're available to the banks. So I think that's what's going to happen is they're going to be looking up at, how do you prove that your models work?
Gotcha. Trust but verify.
Yeah.
Excellent. And so, Dan, and I think you and I talked about this last night a little bit over dinner, about the fact that compliance by its nature is about influencing human behavior.
Right.
And
Absolutely.
so, can you just talk a little bit about how the ability to influence what human beings do in complex systems like organizations will need to change in the future, and the premium that will be placed on human factors and judgment, and that sort of thing?
Yes, for sure. And I think there's several aspects to it. But one thing that Bill just talked about as these models are getting created and in some cases more sophisticated, it just becomes you can't just put someone or label someone, or they have a regular job, and then you're also just saying, oh, and they're also our compliance officer or whomever. You have to have someone that can have the time and the experience to be able to verify that things are being done in a thoughtful way, and that there's the question of transparency. Can you explain it to your employees? Can you explain it to the regulators that come in why you've set up things the way that you have? That's going to be just paramount. An example in terms of the regulators' use of systems. Currently, I'm a part of some working groups that have been launched. We have had summits with various entities in the mortgage space that have included the CFPB, state regulators, the MBA, and vendor tech partners and lenders and so forth that have talked about creating a uniform data format called an LEF is the name of it. And in essence, what lenders are doing is they're taking their information and putting it into a flat file, and then the regulators can take that and use batch uploads to be able to use their tools that they have to extend their reach. And it's interesting watching that process evolve because there's resistance from all sides. And one of the criticisms or queries that gets put to a regulator is, well, if you rely on a system, what if the system, who made the interpreters of the system king, or and the way they respond to that is that it's really a diagnostic tool. There's always going to be value in someone that can do the work on pen and paper, if you will, or tablet, to be able to not just simply rely on a red flag that pops up from a system, but that the systems nonetheless are absolutely vital. And lenders that often don't want their regulators to be sophisticated, it's actually it's narrow thinking, because the end result is either not managing the industry, and we've seen how that works out, or it's going to be a lot more expensive to manage in terms of how many hours that regulators spend at each shop, or what that process looks like. So
let me just jump in here, because you said something really resonated. As we talk about machine learning and everything else, and talk about taking the data and put it into a standard format for the regulators to replicate what you're doing,
right.
What's actually happening in the industry, and I at the clearinghouse, we just put live the real-time payment system, where if any of you use Venmo or PayPal or any of those systems, well, when you do that, it actually looks like you're writing a check still, right? It still goes through the overnight clearing and everything else. The banks extend credit. The real-time payment system, your payment is gone in 7 seconds. Irrevocable, done, right? So when you split the check at dinner, everybody's, you don't have to worry about your brother-in-law sticking you with a bad check. But what's actually happening is, for the risk models for real-time payments to be better, the banks are taking that data, putting it into a shared repository, right? So that we can operate and build all these risk models on everybody's data, right? We get the holistic picture, right? So, you're able to start seeing if there's any trending between banks or anything else. But the regulators love it, because they're saying you're getting a much bigger picture, and they can go there and now look at those models and say, we can do the whole industry.
They love it with a caveat, and the caveat being cybersecurity risk
and
personally identifiable information and so forth. So
absolutely
there's
true.
a tension there too.
I think if you take the word regulators and you go back to the Latin, it actually comes back to the word caveat. Never going to commit without a caveat.
Yeah, that's true.
Yeah, but so when you look at your businesses and you think about the data that you have, right, and how you're going to get the most out of these new tools and these new, how digital is going to help you, it's not going to be by running it on your own small subset of data. It's going to be looking at industry consortiums. Mm-hmm. It's going to look at how you get more information about the entire market and how people operate in it, in order to, get greater insight.
Interesting. So, you guys have touched on a number of things here. One, the value and importance of data. and the ability to put yourself in sort of a defensible position as it relates to the regulators in terms of not just having an answer, but knowing why the answer is what it is. One thing I wanted to touch on a little bit as we wrap up is culture.
Yeah.
You know, and what's your perspective on ways in which we as leaders need to bring some intentionality to the way in which we shape culture, particularly as it relates to risk management. Would either one of you want to pick up on that a little bit and talk about that?
Well, I think that, you know, we've been on a journey to embed risk management and risk thinking in the financial world for 30, 40 years, right? I mean, you know, all the way back to, every time we had a crisis, risk management rose to the fore, right? So, you know, we had the savings and loan crisis, and everybody talked about how to manage risk. And we had, all these, the 2001 meltdown, everybody talked about risk. And part of the problem is risk management only gets that attention after an event, right? And what we're trying to do is get people to understand this risk management has to be built in all the way through. And quite honestly, I think this whole digital environment where we're moving to, that's going to happen. Because now the people who are making the decisions at the top, who are looking about risk, they're going to be able to embed that further and further out. Everybody talks about the Internet of Things, and the Internet of Things is about what the devices are at the edge, which include your phone or other sensors. And what's going to happen is each of those devices will have risk management built into it, right? So when you go to your banking app and you say, I want to do this, it's going to say no. Because the bank has already decided these are the criteria you need to meet. And it's going to give you guidance, and it's going to say, why do you want to do this? So I think that that's the beauty of the digital world, right, is that we're now going to be able to push risk management out to people and get it out there in ways that we've struggled, where whenever there have been people involved, it's always been this, they've always had the competing pressures of, I need to make money, right, or I need to meet my sales targets, or I need to do this. And what happens is that they would shortcut risk management.
Interesting.
Yeah, I mean, one thing I made sure to do, just in the spirit of coming prepared, is I prepped for this this talk by watching the NBA playoffs. And now, how many of you saw on the NBA playoff? Were watching NBA playoffs and saw an ad for Microsoft using Microsoft AI for the beer? There we go. Yep, truth. So there's a tremendous opportunity, tremendous potential. In fact, I think that in the same way that technologies before have been disruptors, enablers, what have you. I mean, and machine learning's been around a long time and so forth. But things like AI and machine learning, I think it's just going to explode, and everyone's going to have to adapt. It's going to hit in everyone's business in some ways, and the power is tantalizing to be able to say, rather than test each thing individually, we can have tremendous amount of insight ferreted out from data. And part of that has to be a culture of sort of being willing to look at adopting these ideas and getting ideas from different areas. But in terms of compliance itself, it may be the most. So like when we're at a party, they'll talk with me and they'll talk to my wife and they'll say, her name's Demer. Demer, what do you do? She's like, I'm a teacher. And they're like, oh yeah, cool, and whatever. And then they'll ask me what I do, and I work for a mortgage company that analyzes automated compliance systems and so forth. So Demer, you're a teacher. Tell me about that. And like, it's not the most naturally, inherently topic that genders enthusiasm, but it should. And it extends into culture from beyond, again, adhering to a single regulation. It becomes woven in, done right, and especially from the leaders that say, we're not going to cut corners. We are going to make sure that we're encapsulating, these goals beyond what the regulators say. We have, being intentional about various aspects of our business. That can extend have dramatic benefits that extend of running a shop that is based on normative ideals that also then get turned into an economic advantage. And I know the example came earlier today about Sephora stores, but I think it's SZA, not just her experience per se, but there's the bigger problem was the company wasn't able to identify that clearly as a bad apple. But it was a cultural thing.
And just one other thing I want to kind of emphasize to everybody, that we always talk about this stuff as if it's coming. Right? The fact is, every day you guys are all being affected by machine learning today. Right? Your Amazon recommendations are all based on machine learning. The ads you see served on the internet, like when you pull up a new page and all of a sudden you see something, oh, I didn't know that why am I seeing a Cowboys, ad? That's all based on machine learning. Right? So it behooves you to actually understand something about machine learning, because as it becomes part of your business, and now you're starting to see decisions that affect how you do business being made by this, that you can understand it and talk to the people who are providing the data and the algorithms and everything else and say, why is this happening? Are we doing this right? Because, if something smells funny, right, whether it's a bias, right, you gave the example of, two people and one got turned down. Now, why is that right? Don't accept it blindly, right? But understand that the people you're going to go talk to are going to talk to you in a completely different language. They're not going to talk to you about real estate. They're going to talk to you about data, and they're going to talk to you about standards, and they're going to talk about algorithms, and you're going to say, that's all great. Explain to me how this happened. And that right now is an unsolved problem in computer science. Right now, when you get very, very sophisticated machine learning algorithms and you nest them all together, we can't exactly explain it, right? It's not that we don't understand it if we get in there, but to explain it easily, fast, translatably, that's still something that's undergoing a lot of research.
Yeah, you're actually touching on something I think is really, really important as a potential second-order consequence of digital transformation, and that is the loss of ability. I mean, I'm old enough to remember when before we had phones. Before we had phones? Before we had cell phones. You had to remember a person's telephone number, right? And so now it's like I don't even know my own telephone number, right? And I know years ago when I was in banking, after I finished our credit training program, and I'll tell you this story about taking my senior credit officer out to lunch. I'll never forget, his name was Frank Coldren, and 20 years ago he had been in banking for 35 years. And we were sitting there having a corned beef sandwich, and I said, Frank, I said, you've been in this business for 35 years, lending. I said, when you boil it down, what's the essence of it? It was like Luke Skywalker talking to Obi-Wan Kenobi, right? And he looked at me and he said, you got to get the money back.
There you go.
He says, if you don't get the money back, it's not a loan.
Right.
And it was like an epiphany, right?
Yeah. Great answer. That's a great answer.
Because, and it's true. And so from that point on, I mean, if you couldn't explain to me with like a crayon how I was going to get the money back, you weren't going to get the loan, right? Because it's not that hard. It's either cash flow or collateral. There's only two ways out of the credit. Right. So you fast forward and we have all these different technologies and tools and all this kind of stuff that's kind of wrapped around this stuff. But at the end of the day, if you're making a loan, you got to get the money back.
Yep. And so what all these things are intended to do, right? This is all about flow, right? The business has changed from the one-offs, to we now have flow. We're trying to handle thousands and thousands and hundreds of thousands of applications, and we're trying to figure out which ones do we have to look at to answer that question with crayons. Right? There's a whole bunch, 80, 75, 80%, that are like, these are bog standard, yeah, they'll be fine, right? Most of our people who take out a mortgage pay off their loans, right? And the ones we have to worry about, and there's a percentage, I wouldn't lend to that guy on a bet, right? Going back to my brother-in-law. But there's the ones in the middle. That's the way to explain how this is going to work. And that's what we're trying to do. We're trying to make it so that you could spend your time on the things where it needs explanation, as opposed to spend your time where it's obviously yes or obviously no.
That's right. That's right. Yeah, and so you have these potential second-order consequences of losing the ability to remember and understand the basics.
Right.
And so, in a way, it's, we have to do both.
Yeah. But I just want to jump in here because we were talking before. You just said, boil it down to one thing. You got to get the money back. Yet this morning, we had a different conversation, right? We were talking about inclusion, right? And now you have two goals, right? And so now you have to start thinking about how do you balance those goals, right? Clearly we want to lend to people who are going to pay us back. But, we don't want it to become something where the machine is saying, well, we're not lending to that person because they're X.
Right.
Right? He told the story about the prime candidate for a perfect mortgage, except he was black.
Right.
Right? And the guy wouldn't lend to him. And boy, I'm glad he said his name 4 times. Right? But we want to make sure the machines don't ever fall into that.
Well,
we want to make sure the machines are, they're looking at what's truly important to make sure we'll get our money back, and not looking at things that have bias.
Well, and that's what we were talking about earlier, where those kind of decisions have to be made in the design of the system. You can't wait until you're looking at output in order to figure out what could be or what might be wrong with the result. That's the key. And so, we have about 10 minutes left. Anybody has any questions?
Yeah, it's a hand over there.
Is there a hand up?
Yep.
Okay.
Can you just wait for the mic, because I know I can't hear, so there's a mic right there. Thank you.
Okay, with lack of communication, because everything is computer-based nowadays, what happens when the person when they're no longer, when they're not qualified when they apply for a mortgage? When, they are qualified, but then the computer says, okay, you don't qualify. What do you do? Because, this person will tell this person, next person, 10 people, you've lost business.
Right.
Yeah.
That's right. You're trading off revenue versus risk, right? And what we're really looking for, and I've been around long enough to remember the pre-mortgage crisis, right? Where, banks held their mortgages, so the risk profiles, they lent to people based on their risk appetite. And then we started securitized mortgages, and we divorced revenue. We divorced revenue from risk because you could package it and move it along, right? So then what you have is, how do you answer that question when somebody says, why didn't this person qualify? And what you want to be able to do is to be able to give them the parameters, right? That said, look, for you didn't qualify because you got 14 negative records, items on your credit rating. You need to work on getting your credit rating up, right? Or your credit, or you don't qualify here because you're asking for. We used to have the rule of thumb, right? 28% of your gross couldn't go to your mortgage payment. And remember that rule? No. So you want to say you don't qualify for this loan because your income isn't high enough, right? You would qualify up to this amount. So maybe what you need to do is wait 6 months or a year and save this much more money, right? That's what you really want, because you don't want to turn them down yes, no. You want to turn them down and help them get to yes. You want to be able to direct them to what will get us to the point where our risk appetite would say, we can lend you that money.
I think there's an art versus science to this as well, right? And I know there are some organizations that understand that and that balance. The science part is the algorithm says, no to the loan. The art has to do with, and it all goes to, what's your business model, right? There are some organizations that have business models that are built around getting closer to that human being and where the decision is made, and really kind of getting underneath the numbers and understanding the true nature of the risk that they might be exposed to, and then make a decision based on that. And so if you have a business model that can sustain that kind of interaction, and you can thrive in that, then in some cases there's money to be made there.
I want to get back to you.
The numbers don't always tell the story.
Yeah, I want to get back to you for one second. How many people here remember, know what a FICO score is, right? We all do, right? And we all know that it's a continuum. right? You know, it goes from 400 to whatever, right? I don't know what the top one is because I'm never there, right? So your question was, hey, some algorithms and some systems that we build are going to say yes and no. That's not helpful. But if this algorithm is able to provide you with a classification that's a gradation, like a FICO score, that says, hey, you know, we lend to people who have FICO scores over 650, you're at 630, right? And the only reason you're at 630 is the following. So you want to talk to the people who are putting in these algorithms, like, how do I get continuous viewpoints? I can't, the yes-no is not good enough. I need to have a risk rating or a how close am I and what do I have to do to get me there type of system. And that's what you go to your systems guys, you go to your data scientists and you say, that's what I need to run my business well. I need explainability and I need, you know, a gradation as opposed to absolutes.
Your question was so good too because it's about the communication part, which is what Bill's addressing. And then it's so tricky too because, you know, you think about, you know, maybe there's a digitally savvy buyer, first-time buyer, we'll say millennial, and they may have largely done the home searching process even from their home through virtual tours and, you know, technologies that, you know, some of you all are hopefully employing or looking at employing. And then they get to the lending side, and you began your remarks here at the beginning of the hour here, Bill, by saying you used to, you know, show up and have a face-to-face conversation with someone. They may be using a point-of-sale system that a lender has created. There may be very little engagement with anyone, even the realtor to a certain extent, although hopefully, you know, I mean, obviously they're going to have someone walk them actually through it, but it's going to change the way they search. They're going to be searching a whole lot more homes on their own, perhaps in certain instances, and yet it comes down to the decision, and then it requires communication. And the conundrum is, how do you have something, if you say you built a hard stop and you said, you know what, below, you know, 680, there's, you know, this certain, you know, you fall off a cliff. Well, that's such a, you know, like, is that the right way to set up your model if it's almost like it's a spectrum? And what is 2-point difference when they have, they're clearing the collateral hurdle by a huge margin? Right. And then you fall to the art side, which that's where the tension is, because yes, that's good to be able to think things through, but even that, I would encourage everyone to have clearly explainable parameters.
Correct.
And so it doesn't just become art as a catch-all, because what happens is certain branches will follow art differently than other branches will follow art, and then you, through a backdoor process, have injected the same problems that have belied the industry for decades, and you've reintroduced unexplainable or sadly explainable, you know, bias.
I think what you just said is art is a very short word for capriciousness.
Be careful.
Mm-hmm.
Yeah.
Mm-hmm. Excellent. Any other questions?
Nobody?
Okay.
Thank you very
All right.
much.
Thank you.
Appreciate it.